Have you ever wondered how to gauge a company's financial health and its ability to generate cash? Financial ratios like the debt-equity ratio and the price-to-cash flow ratio can provide valuable insights. The debt-equity ratio, a measure of a company's financial leverage, is calculated by dividing total debt by shareholders' equity. Total debt includes short-term and long-term obligations, and shareholders' equity is the value of the investment shareholders have in the company. This ratio is a staple tool for investors and creditors to assess the riskiness of a company's capital structure. A higher ratio indicates that the company relies more on debt, which could mean higher financial risk, especially during economic downturns. Yet it's important to remember that a higher ratio might also signal opportunities for amplified returns during periods of growth. On the other hand, the price-to-cash flow ratio measures a company's market price per share relative to its operating cash flow per share. Unlike earnings-based valuation metrics, this ratio focuses on cash flows, which can offer a clearer image of a company's ability to generate cash. A lower ratio might suggest that the company's stock is undervalued, making it potentially attractive for value investors. In summary, both the debt-equity ratio and the price-to-cash flow ratio serve as key indicators for assessing a company's financial health and valuation. A careful analysis of these ratios can help to evaluate the risk and value associated with a company's capital structure and cash flow generation. However, as with any financial analysis tool, these ratios should be used in conjunction with other indicators and industry-specific factors to make well-informed investment decisions.
Do you know how to evaluate a company's ability to service its debt? It's an intriguing question, isn't it? Well, there are several financial ratios that can provide insights into this. Today, we'll delve into two of them, the interest cover ratio and the CFO PAT ratio. The interest cover ratio, also known as the times interest earned ratio, is a crucial tool in measuring a company's ability to cover its interest expenses with its earnings before interest and taxes, otherwise known as EBT. The formula for this ratio is simple: EBIT divided by interest expenses. So, if a company's EBIT stands at a higher multiple of its interest expenses, it indicates that the company can comfortably meet its interest obligations. This ratio is essential for creditors assessing creditworthiness and investors evaluating the company's financial stability. Moreover, it helps mitigate the risk of default on debt payments and boosts investor confidence. Next, we have the CFO PAT ratio. This ratio compares cash flow from operations, or CFO, to profit after tax, or PAT. The formula for this ratio is also straightforward: CFO divided by PAT. A high CFO PAT ratio means that a significant portion of a company's reported profits is backed by cash flows from operations. It's a good indicator of the sustainability and reliability of a company's earnings. Analysts use this ratio to assess how effectively a company converts its accounting profits into actual cash flows. Moreover, a strong CFO PAT ratio suggests that the company's profitability isn't just based on accounting adjustments or one-time gains, but is backed by healthy operating cash flows. So, in summary, the interest cover ratio and the CFO PAT ratio are two powerful tools for evaluating a company's ability to service its debt. The interest cover ratio helps assess a company's ability to cover its interest expenses, while the CFO PAT ratio provides insights into the quality and sustainability of a company's earnings and cash flows. Understanding these ratios can be a game changer when it comes to making informed investment decisions. So the next time you're analyzing a company's financials, keep these ratios in mind. They could be the key to unlocking valuable insights into a company's financial health and its ability to manage debt.